Welcome to HouseLux Estate, your reliable source for investment and real estate insights. Today, we're turning our attention to a topic that's sparked curiosity in both beginners and seasoned investors alike: undervalued stocks. This intriguing world of potential profits is often misunderstood, yet it presents a wealth of opportunities for those willing to navigate its nuances. Undervalued stocks, as the name suggests, are shares of a company that are trading for less than what they are actually worth. This discrepancy between price and value can occur for a variety of reasons, from market volatility to overlooked potential. And why does this matter, you ask? Well, because it means there's a chance for you to buy these stocks at a bargain and potentially reap significant profits when the market corrects itself. So, grab your note-taking tools and prepare for an insightful journey. Stick around as we delve into the process of identifying and capitalizing on undervalued stocks. To start, it's important to understand what undervalued stocks are. They're a bit like hidden gems in the vast marketplace of stocks and shares. Undervalued stocks are shares of a company that are trading for less than their actual or intrinsic value. This intrinsic value can be determined by all aspects of a business: its current performance, its future prospects, the value of its assets, and more. Essentially, it's a comprehensive measure of what the business is truly worth, but sometimes, for various reasons, the market price of a company's stock doesn't reflect this intrinsic value. When the current market price is less than the intrinsic value, we call this an undervalued stock. So, what causes a stock to be undervalued? There could be several factors at play here. It could be due to an overreaction to bad news or disappointing earnings, which drives the price down. It could be that the company belongs to an industry that's currently out of favor with investors, or it could simply be that the company has been overlooked or misunderstood by the market. Sometimes a company might be undervalued because it's not very exciting, it's just steadily doing its thing, generating profits, and growing at a slow but stable rate. In these cases, the lack of hype or buzz can result in a lower stock price, despite the company's solid fundamentals. Other times, a company could be undervalued because of short-term challenges that have caused investors to flee. These could be problems that the company is more than capable of overcoming, but the market's knee-jerk reaction has resulted in a lower stock price. In essence, an undervalued stock is like a discounted ticket to a show, the show being the company's future earnings and growth. The discount is due to the market's current perception of the company, which, for one reason or another, is less than favorable. Now that you know what undervalued stocks are, let's move on to how to identify them. Identifying undervalued stocks requires a keen eye and a good understanding of the market. So let's delve into how we can equip ourselves with this knowledge. First and foremost, we need to understand financial ratios. These are tools that can help us assess the value of a company's stock compared to its earnings, its assets, and its dividends. Three commonly used ratios are the price-to-earnings ratio, the price-to-book ratio, and the dividend yield. The price-to-earnings ratio, or PE ratio, is calculated by dividing a company's market value per share by its earnings per share. A lower PE ratio could suggest that the stock is undervalued, but it's important to compare this figure with other companies in the same industry to get a clear picture. Next, we have the price-to-book ratio, or PB ratio. This ratio compares a company's market value per share to its book value per share. The book value is essentially what a company would be worth if it sold off all its assets and paid off all its debts. A lower PB ratio could indicate that the stock is undervalued. However, just like with the PE ratio, it's crucial to compare the PB ratio with other companies in the same industry. Finally, we have the dividend yield. This is a financial ratio that shows how much a company returns to its shareholders in the form of dividends. A higher dividend yield could suggest that the stock is undervalued. But ratios alone are not enough. It's also vital to understand the company's financial health and its position within its industry. Is the company profitable? Does it have a competitive advantage? Are there any red flags in its financial statements? These are all questions worth considering. Once you've identified potential undervalued stocks, the next step is to capitalize on them. But that's a topic for our next scene. Stay tuned. Capitalizing on undervalued stocks is where you get to reap the benefits of your research and analysis. This is the stage where your understanding of the stock's true value and your patience can pay off handsomely. One of the most common strategies for capitalizing on undervalued stocks is the buy and hold approach. This strategy involves purchasing the stock at its undervalued price and holding on to it until the market corrects itself. The market correction happens when the rest of the investors realize the true value of the stock and the demand for it increases. This, in turn, pushes the price up to its intrinsic value. One of the key aspects of this strategy is patience. It might take time for the market to recognize the stock's true value, but if your analysis is correct, the wait can be well worth it. Another strategy to capitalize on undervalued stocks is using options. Options are financial derivatives that give you the right, but not the obligation, to buy or sell a stock at a specific price within a certain time frame. By using options, you can potentially profit from the rise in the stock's price without actually owning the stock. This strategy can be a bit more complex and requires a deeper understanding of the financial markets. Regardless of the strategy you choose, discipline is crucial in this process. It's easy to get carried away by short-term price movements and lose sight of the bigger picture. Remember, you're investing based on the stock's intrinsic value, not its current market price. Don't let emotions drive your decisions. Stick to your analysis and have the discipline to wait for the market to recognize the stock's true value. On that note, it's worth mentioning that investing in undervalued stocks isn't a guaranteed path to profits. Like any investment strategy, it comes with its own set of risks. Your analysis could be wrong, or external factors could influence the stock's price. That's why it's essential to diversify your portfolio and not put all your eggs in one basket. Capitalizing on undervalued stocks can be a profitable strategy, but it requires diligence and patience. So keep researching, stay disciplined, and remember, the market can stay irrational longer than you can stay solvent. Let's recap the key points we've covered today on how to identify and capitalize on undervalued stocks. We began our journey by understanding what undervalued stocks are. These are shares from companies that are trading for less than their intrinsic value. Essentially, they're stocks on sale. This discrepancy between market price and intrinsic value is what offers the potential for significant returns. But remember, not all cheap stocks are undervalued, and not all undervalued stocks are cheap. We then dived into the process of identifying these hidden gems in the stock market. This requires a blend of quantitative and qualitative analysis. On the quantitative side, we're looking at financial indicators such as the price-to-earnings ratio, the price-to-book ratio, and the dividend yield. These ratios tell us about the company's profitability, value relative to its assets, and its ability to generate consistent cash flows. On the qualitative side, we're considering factors like the company's competitive advantage, management quality, and industry prospects. These aspects give us insight into the company's potential for long-term success. But identifying undervalued stocks is just the first step. The real game begins when you decide to capitalize on these opportunities. This means buying these stocks when they're undervalued and holding on to them until their market price reflects their true intrinsic value. Sounds simple enough, right? But it requires patience and a strong understanding of market dynamics. Remember, the stock market is a volatile beast. Prices fluctuate due to a myriad of factors, many of which are beyond our control. That's why it's crucial to have a well-diversified portfolio. This way, even if some of your investments underperform, others can compensate for those losses. Also, it's important to realize that investing in undervalued stocks is not a get-rich-quick scheme. It's a strategic move for those who are willing to play the long game, who understand that great returns come with time. Lastly, let's not forget about the importance of continuous learning. The stock market is an ever-evolving entity. Strategies that work today might not work tomorrow. So, stay informed, stay curious, and stay adaptable. To sum it up, identifying and capitalizing on undervalued stocks is a skill that could potentially lead to substantial financial gains. It requires a sound understanding of financial metrics, a knack for qualitative analysis, a well-diversified portfolio, patience, and a continuous thirst for knowledge. Thank you for joining us today at HouseLux Estate. Don't forget to subscribe to our channel for more insightful investment and real estate content.